like to thank the organizer, SMBConnect and the RISE invited me to this wonderful gathering where I'm interacting with the businessmen like you who never think of largely the investment part. Otherwise, there are startups who keep looking at us for the investment. My introduction is I am Amit Singal, run a fund called Fluid Venture where we invest in direct-to-consumer brands at early stage. So our ticket size is 2 to 4 crore rupees, where we invest at a stage of a startup where they have a turnover of around 5 crore rupees, and they are looking for a handholding to bring it to the 25 crore rupees. So how this happens? So typically what we do, we invest 2 crore rupees in the company. Normally they raise another 2 crore rupees in the form of equity. We also invest in equity only in the company. So we don't invest in debt. We don't invest in any other form of investment. We purely take an equity in the company. Typically we take 7 to 8% in the company depending upon the turnover, their gross profit, their margins and other metrics. And they take another 2-3 crore rupees from the other investors. So by this 4-5 crore rupees, what they do, they try to utilize this money in a so efficient way so that they can reach at a stage of 25 crore rupees turnover, and then they raise larger round, maybe of 15 crore, 20 crore rupees, which we call as a Series A. And by utilizing that money, they try to make it a 100 crore rupees company. Why I am telling you this journey? Because that journey is very important, because unless and until you are a 100 crore rupees brand in India, normally you do not get an exit or you do not get an entry to the SME platform listing. So that's how this journey become very important for any kind of SME platform. Now the question arises that whenever we talk about the startups, normally you must have heard that the VC funds like us, we only invest in the tech companies. And there was an interesting incident where someone asked me, do you invest in tech company? I said, I invest in direct-to-consumer companies. He said, okay, so it means that you are investing in non-tech companies. Then I explained him that this is not like that, this is a not tech company. When we are talking about the direct-to-consumer, at every step you need tech. The only difference is that your product, the core product which you are giving to the customer, that is not a tech product. You are giving some tangible product to the company, to the consumer, but on the same side, start from the beginning. When you are talking about the communication to the customer, you are not interacting with the customer in the physical form. You don't know him, how he looks like, how he is gazing with the brand communication, whether he is able to correlate with himself to the brand or not. So the brand communication is the key part for every D2C company to gauge their customer. So first itself, communicating with the customer itself required lots of technology. Now customer is ordering you. Their word is where they were calling to the customer care. We have seen the journey of Home Shop 18 and similar kind of D2C channel, where what you have to do, you will have to call, you will have to put your order, and then the product were coming to you. Nowadays, you require some platform like platforms like Amazon or Flipkart, or maybe your own websites where the customer can order you and you can deliver that goods. Again, the technology requirement is there. For payment gateway as well, taking the payment from the customer, payment gateways are required. Again, technology involves delivery. Lots of supply chain companies are there who help you to deliver the goods. Again, the technology is required. Communication to the customer that your goods are about to reach, some SMS services are required. So you will see that whenever we are talking about direct to consumer, entire journey is about the tech only. Without tech, you can't do anything. So that's why it is very important to understand the utilization of the technology. And in the first session itself, we have understood that how the technology part is extremely important for any kind of D2C brand, because you can't run a D2C company without technology. Now coming to the strategic investment part, whenever you raise a money, it is very important for you to understand that from whom you are raising this money. It can be bank loan as well. It's not necessary that you always think about the equity capital. If you are raising the money or the finance from the bank, that is the first option which you can raise. But mostly we use the bank loan for the working capital requirement. But nowadays, the D2C want a fast growth where they want to utilize the money in the advertisement, in the form of another innovations, because in D2C brand lots of innovations are required. So in that case, if you will take a bank loan, that will become a liability of the company, and that may not be possible that you will be able to utilize that money for the innovations or the marketing purposes. So normally whenever you are doing some innovations, you want to grow your team member, so there are certain challenges to take these debts. So in that case, you should look out for the equity option where you can have a partner. It can these partner can be VC funds, these partners can be family offices, these partners can be friends and families, these partners can be individual investors as well, who have a relevant experience in the particular category. So I always suggest that whenever you are raising money, you should do a due diligence of the investor as well. You should see the background, how they are contributing in your business. So if you find that there is great synergies with the investor, you should always look for those investment options. So whenever you are raising money, there are 2-3 components which investors look in any direct to consumer brands. The first important metrics is gross margins. Normally we are confused that different categories are getting different kind of multiple in the companies, because at early stage it is not possible for us to do a valuation based on the net profit or the EBITDA level. We normally look for the top line, because in early stage most of the companies are not profitable and the growth opportunity is so high. So we typically use the revenue multiple between 3 to 6x depending upon the gross margins. So the gross margins are extremely important for any investor to look in the startup. The more the gross margins are, you will get more valuations. In case the gross margins are not so good, we don't invest in that company. So typically we look for more than 70% gross margin in any business, because unless and until you will have a gross margin of more than 70%, you will not be able to contribute some money towards marketing and the supply chain and other things. So whenever we think about any D2C company, 30 to 35% goes to the COGS, which is the direct consumption. Typically these days the cost of acquisition of any customer is around 1/3. Again, whenever you are spending 1 rupees in the SEO or Meta or at any other platform, you are getting sale of 3 rupees. That is the general trend going on for last 2 years. And remaining 1/3 is required for the fixed cost of the company. It may be of your rental, it can be of your corporate salaries, etc. So typically after 70% gross margin, you will end up by 20% net profit after a particular stage. That stage will also require some particular traction. It's not like that on the first day itself there will be profit, but the path to profitability should be very clear in the founder's mind, that when the profitability can become, at what stage. Maybe it can be at 5 crore rupees sale, it can be at 2 crore rupees sale, depending upon the different kind of businesses, that can be at anywhere. But as a founder, the profitability should be clearly demonstrated to the investor, that when that will come. Based on that, investor take his decision, and then he makes his mind that at what valuation I can enter into this company, and at what stage I can get an exit, either through bigger investor, or maybe through listing in a SMA platform, or maybe the main board as well. So now this is a great era where we are seeing lots of SME platform listing as well. So earlier when we were investing in D2C, so I started my angel investment journey in 2015. My first investment was Burger Singh, second was Inner Chef. After food and beverages, I invested in some D2C companies like PSafe, Neiman Shoes, and there are many other companies where these opportunity of listing were not available. But now this is coming as an additional opportunity for us as well as an investor to get an exit through that route as well. And as a founder, definitely you should look out for that option as an alternate to the private equity or the VC fund, because if you have a good growth rate story and you have a good run rate in terms of sales, etc., you should definitely look out for that options as well. So as I mentioned that Fluid Venture only invest in direct to consumer. So how this strategic investment can help any startup? Because we know all the challenges, like the cost of acquisition is improving and increasing day by day. So what we did a closed door meeting with all our portfolio companies, that how it can be reduced, and we come up with the solution that the future is going to be for 3C in the direct to consumer, where the community will play a significant role in any kind of sales proceed for the communication. Whenever we get a validation from some other community member or the other peers, we are more inclined toward buying rather than seeing the advertisement. I have heard this as well from very senior person in the advertisement space, that after 5 years there will be no advertisement. Like one of my colleague also mentioned in earlier discussion that when someone was doing an advertisement in Hindi, they were not use the big influencer, because going forward you are not going to believe in the advertisement. More or less, you will believe in the peers who is using that. You will see the traction, or you will see the validation from the other customers only, then only you will buy. So that's why companies are more focusing towards the community building and the brand communication, rather than having the loads, spending lots of money on the advertisement. Content is going to be key for any D2C brands. Unless and until you will push some good content about your brand or the product, no one is going to buy. So you should always focus on these parameters as well. So I would like to make it more attractive, interactive, rather than having a solo thing. So we'll be happy to take your questions around investment part. We'll be happy to answer that. And once again, I would like to congratulate for this wonderful event organized by the organizer. The name of the event itself is very near to my heart, because 2 years ago, I in a media interview, I mentioned a word called D2C 2.0, and I start receiving a call from multiple people where they ask me that what is going to be 2.0, are you talking about the industry revolution? Because most of the time when we talk about industry 4.0, people start thinking that rather than outsourcing the production, now the next wave will be where you will have your own factory. I said, no, I don't believe in asset heavy models. We as in VC fund, we always believe in asset light model where we want the production to be outsourced. When I am talking about D2C 2.0, which means that these earlier wave was only for the premium category. Now the next wave will be for the mass product, because now you have seen the most of the D2C players are targeting tier 2, tier 3 cities for the Bharat. So that's why the name is very attractive, where they are saying Bharat D2C, because the next wave of the entire consumer space will be of the tier 2, tier 3 cities. The cost of the per capita income of the tier 2 cities is increasing drastically, and there is an aspirations to buy these products which are not available in these cities, because in metro cities most of the times we have mall, we have shops, and the product is easily available. While in tier 2 cities there is internet connectivity, there is credit card, debit card, everything is there, but they are more inspired towards these products. So whenever you are working on the D2C brand, you should target tier 2, tier 3 cities, because that is going to the future. By saying that, thank you very much once again. We will be happy to answer your question.
Good morning and thank you. And we're glad that someone from investor community is here. Okay, and my name is Anubhav Sahani. And just like to put up a question here, which I think would be very dear to heart of many of the entrepreneurs, because whenever we reach out to the investors, right, the first question that pops up for the entrepreneur is that what is the kind of revenue you are generating? Okay, and then they start the discussion. But here and it's again a very catch-22 situation, because whenever you're trying to do something big on a bigger platform, for example, a pan-India rollout, to start generating revenue, you have to, the market is so competitive, you have to invest a lot of money in marketing first to build a certain level of credibility before the funds start to roll in. And that's where I think most of the entrepreneurs are stuck here as to how to start, because
Sure.
So you understand my question, right?
Yeah, sure. So let me
answer
that. Definitely this was a problem 2, 3, 4 years ago, but nowadays there are lots of incubators and accelerators which are available in the market, and most of the incubators are supported by the government, which help you to do a POC. What is POC? Proof of concept, where we start creating the product, because for any D2C brand, the key is product. Unless and until you will have a great product, you can't sell it into the market. So what you can do, you can choose a small market. You can take a part in any incubation centers like MAT, BIMTech. There are around 500 incubation centers who support at early stage with a small money in the companies. They sometimes provide a soft loan, sometimes they give you money against equity as well, and sometimes it is a compulsory convertible note. So after validating your product in a small market, definitely you can go to the angel network, or the angel fund. There are various angel networks in India like Mumbai Angels, Indian Angel Network, Karatsu Firm. So they help you at early stage. Now it's depend, in case the founders have their own money, they can go bootstrap for a longer period so that they can save their equity for the longer time. But in case the founders don't want to do an experiment with their own money, the best way is to reach out to the angel investor and who help you at very early stage. Like I mentioned about PSafe, I was the angel investor in 2017. The company was incorporated in April 2017 and I invested in June 17. So definitely we get the valuation very attractive and we get more shares with the same investment. If I will invest from the fund at a later stage where I am looking for a sale of at least 5 crore rupees, definitely I will not get the equity equivalent to what I could get in the angel stage. But again, it depends upon my risk appetite, whether I want to take a risk at early stage or I want to invest in those companies where they have achieved or a certain level, like 5 crore rupees turnover, which I mentioned that is a fundamental baseline for our fund to look at any startup. So definitely there are lots of opportunity for early stage as well, but proof of concept is important. As an investor, we always look for the pricing, whether a customer is adapting that price or not, repeat rates are there or not, whether customer is coming only once to your website or buying your product after looking at the advertisement, or he himself is coming again and again. Once you will collate the data on the small market as well, the investor will be happy to give you money to expand it to the larger audience. I hope I answer your question. Yeah, thank you. Any other last question? No question? Okay. Yeah, please.
Yeah, good afternoon, and thanks for this insightful session. My name is Vivek Dhawan. I represent an EV startup called Omega CK Mobility. We are based out of Jusela in Delhi, and we have 2 factories, one in Faridabad and another in Pune, right? So in addition to vehicle manufacturing, we do the mobility services also, which also is a startup, right? And we are obviously looking at, scaling, the fleet size which we have currently, right? And the biggest, obviously, challenge is that we don't have that kind of funding available with us, right? Though we have good contracts with companies like Amazon, Flipkart, Licious, Blinkit, Zomato also works with us very, very closely. So, in our case, and look at, if you actually look at the future, everyone is actually going for, the sustainable, way of doing or delivering goods. So your condition of 70% gross margin, right, which actually for you is a must. So though we can actually, show you numbers, we can show you top line, but, getting 70% margins in our kind of businesses, really unthinkable, right? We can't even think of, doing those kind of margins. But in terms of top line, in terms of even a reasonable bottom line and cash flow, we are sorted. So how can you, extend your help to companies like us? Yeah.
Sure. When we talk about consumer goods, it doesn't include the cabs or the mobility sector at all. When we are talking about consumer, so first fundamental test is it available on quick commerce or the fast commerce or the Flipkart or Amazon or any other marketplace like beauty products or others, because the repeatability is the very important factor for treating it as under consumer product. So sometimes we confuse between the consumer product and the B2C companies. So whatever you are manufacturing, that is not D2C, this is B2C. Where you are a business and you are selling to the customer, it is not a consumer. Consumer is something which is consuming something and the consumer product should be there. So in your business, definitely no one will expect 60-70% gross margin. And when I'm saying about 70% gross margin, it's largely when your inclination is towards a direct to consumer. Because if you are selling online first, definitely you will require higher margin because you don't have any distribution channel, you don't have any advertisement budget, etc. You are trying to sell directly. So unless and until you will have 60-70% gross margin, you will not be able to make profit at any point of time. You will grow very faster, but at the end of the day, the break-even point will not come. That's why, and again, this is our fund thesis where we want to invest in that high margin businesses. There may be fund who are very particular about particular subcategories. Like there may be fund who is only investing in healthcare, companies under D2C. So they may not look at 70% gross margins as well. So it purely depend upon fund to fund how they are look at it. But I mostly seen that in case as a founder you don't have 70% gross margin in the consumer product, you never able to make the money from direct to consumer strategies. That's the thing. Otherwise, mobility is not at all part of the D2C sector.
There is actually one piece which is part of D2C. Maybe we can have an offline discussion, right, in the interest of
Sure.
time. Thank you so much. Thank you.
Sure, very much. Thank you very much. Thanks once again.